Welcome back, Alejandro. I'm so excited to learn more with you. And today we're talking about Lowe's. So welcome back, Alejandro, and please take it away.
Hello, Michelle. Hello, everybody. It's a pleasure being here. Today we're going Lowe's, something different. I'm a dad now, so I'm happy. I'm talking from a different mind.
Wow, congrats.
yeah, it's gonna go well. So Lowe's. I mean, when we think about Lowe's, obviously we talk about home improvement, and obviously right away we probably think about Home Depot. So are the two big guys, and obviously it's related to real estate, which is the biggest market in the US. So it's a very important market. So let's get started. So who are they? Lowe's was founded in 1921 with opening its first hardware store in Wilkesboro, North Carolina. They started way before Home Depot. Lowe's right now is the second largest retailer in the world. As of February 23, they had 1738 home improvement stores in the US, representing approximately 195 million square feet. They used to have a big operation in Canada, which was around 5% of their sales. But last year they decided to simplify the business and sold that part of the business. This hit the income statement because they had a loss of like 2.5 billion related to goodwill that they paid before. And again, as we always said, I mean, these are decisions by big management. They do have a very interesting CEO, Marvin Ellison, which I want to talk a little about because he is a very impressive guy. He came out of basically nowhere, one of the first people who went to college in his family, little family, poor, but well, he started at Target, then went to Home Depot, and then now leading Lowe's, and that is to me very impressive. And from there, the Lowe's culture departs. I mean, everything is possible. Lowe's is an omnichannel retailer whose priorities are to provide an excellent customer experience, create a great place to work for associates, and improve the communities, which they believe will create long-term sustainable value for shareholders. Obviously, as I said, I mean, they are working very hard in this integrating the online sales with the store sales because different from many retailers, people here still want to go to the place just because the sales that Lowe's does are not like your week-to-week grocery store. So this part is very important how they integrate this. And I personally am a Lowe's shopping. I mean, that's where I go when I need something for my house. How about you, Michelle? Where do you go?
Yeah, either or. I'm happy to go to either Lowe's or Home Depot. They both have very competitive pricing, and being that Lowe's is run in a very similar way to Home Depot, it makes sense that you get great value at Lowe's as well.
Yeah, absolutely. So um, I don't want to make the whole presentation about Lowe's and Home Depot, but I'm going to mention something later on about them, and that's it because I think Home Depot deserves its own presentation. So I think maybe we can do it in future weeks. So here's a very interesting part. The market is divided in three potential customers: the pros, obviously, the renters, the people that rent their house, and the individual homeowners. There's a separate segment here, which is do it yourself and do it for me. And the three major segments are home decor, building products, and hard lines. Here is the part where I want to integrate Home Depot and Lowe's, and one of the big difference. 5% of customers are pros, which constitute 25% of the sales at Lowe's. 95% of the customers are do-it-yourself, which constitute the other 75% of the sales. So as we can see, the pros are probably the most important customer for Lowe's and obviously for Home Depot, just because these people shop 5 times as often as a just a normal do-it-yourself person, because they have their contract, they get hired. And one of the things which I found personally very, very interesting about these two with this business is that like you being a contractor, you are not playing with this. So basically you are very limited on time. So when you are a customer for Lowe's, you keep going to Lowe's, and when you are a customer for the competition, you keep going to that one because you know where is the aisle, you know what's the product, and you just keep going because just because you save $1 is not going to make that big of a difference. But if you can save time, if you can save certainty of the product, you are going to keep going. And that's why one of the things I find very difficult for one or the other to take market share. So right now, Home Depot sells about 50 billion more than Lowe's. So basically Lowe's sells around 100 billion and Home Depot sells 150 billion. And this composition in Home Depot, like the one I'm just showing here, is 10% of them are professionals, which again, like I said, they buy 5 times more. So 50% of the sales for Home Depot are by pros, which this is one of the big reasons they are so much more like profitable and bigger, because pros in their majority trust Home Depot more. I mean, they have specialized, and this is the big competition. One of the big things that I like about Lowe's, and it makes me dig and try to really get to a conclusion to maybe invest some money on it, is that Bill Ackman, which obviously is someone we all look to when trying to learn about investments and get better as investors, has a very big position in Lowe's. Last year it was the biggest position for him. So if he does, I mean, obviously you at least want to check it out. So the market size in the US, how it has grown. So in 2008, it was a little above 250 billion. By 2025, it's projected to be almost in that 600 billion. So it's a growing market. I mean, obviously it has taken almost 16 years to double, but again, it's a very important market. It's a very predictable market because whoever you are a hotel, you're a homeowner, you need to fix your stuff, and it's not like you can just leave your toilet just messed up or something. You need to do this. And when economy is good and a lot of women or even guys want to remodel their house and they have the money, they use it. So it's a business that even in recession or no recession is working. So obviously this is great for us as investors. So the variables that affect demand are home price appreciation, age of the house, disposable personal income, housing turnover. And this is one of the parts I find very difficult to predict with this segment, because let's say in 2010, they built, I don't know, 500,000 houses. So obviously these houses are going to get all at the same time in, I don't know, 15, 20 years, and they going to still needing to get repairs, remodels, and all of this is just very hard to predict. But as long as they are in business, I mean, they are going to do good. And they are, as we're going to see later on, they both are very profitable. They have a great return on invested capital, which is what we are looking for as investors. Obviously, as I said, I mean, I'm talking really good about it. It doesn't mean I'm advising to invest in, because again, we have to get to our conclusions. We have to get to our own conclusion, I'm sorry. And just because it's a great company doesn't mean it's a good investment, because it can be very, very pricey, for example.
Right. Yeah. So everybody has to do their own research. Like, no, none of these presentations are advice or anything. Like, we're not saying anybody should or shouldn't invest in this company, but it's just a great learning example of what kinds of factors to look into if you are interested in a potential publicly traded company.
Yeah, absolutely. So right here, as we see, are the division that I said before: home decor, building products, hard lines. And as you see, I mean, they're very similar in the proportion. The other is basically services, which is when they go to your house and install something for you, like them, because most of the time you just hire a third party, or they advise you to, oh, go with this guy to install your bathroom, or they have these contractors that they work with. But the last line, which is only getting to 3%, is done by them. The sales by specific product, and again, this is our around 15 products. As we see, they are very stable. They don't vary that much. I mean, the most important, as we see, is appliances. Lumber is very important as well, and they have grown in a similar way. I mean, it's not like, as we see, one of the other is growing faster, but so the income statement, we can see they keep growing. The net earnings keeps growing, but as I said before, when they sold the Canada business, they took a hit of $2.5 billion. So if you take that out, I mean, obviously, we're always doing accounting gimmickry to justify what happened, but I mean, that's what happened. They just took basically a goodwill loss, so it hit the income statement. The balance sheet is something we always want to check out, and as we see, the property is around 18 billion, and they have inventory of around 18 billion as well. The inventory has grown, which obviously we don't want to see, because that's money that company has to be putting as working capital instead of just being financed, and accounts payable has gone down. So I usually don't like to see accounts payable going down and inventory going up, because it means it's working capital that I'm having to hold for them to make money instead. I mean, I'd rather have all the bigger the accounts payable, obviously in a safe way, because I mean, it can come a period where you are not able to sell your inventory, so you just owe a lot and you have to pay quick. The debt, as we can see, has gone up also. It went up on almost 10 billion from the past year to this one. And good or bad, I think, I'm not sure how to value this, but all I can say is that what they've been doing with the money, which is something we always have to be looking at in every investment that we do, is that just rebuying their stock, which means they really trust that what they're doing as a business is great, and they think their stock is undervalued, obviously, because I mean, doesn't mean every company does it, but I'm sure they do it because, I mean, having Bill Ackman behind, I'm pretty sure they are very conscious about buying the shares at a price where is good for them. So even though they're growing their debt, the actual shareholders are getting a bigger piece of the pie, which is good. So
yeah. Well, and I have some questions about that. Like I can see how, say, a company, if they were able to get a low debt percentage, so if they owe only 1% on the debt that they've gathered, and they use that debt to buy back their shares, which they think might be undervalued by, let's say, 10%. So if really you're still gaining 9% in value, even though you owe 1% on your debt, it could be argued that that's a good use of leverage to buy back stock for that purpose, maybe. But also, I have a question about the kind of debt. Is it how much like short-term debt compared to long-term debt do they have? Because the short-term debt, I've learned from investors like Phil Town, that the short-term debt, as long as it's not too huge, we don't have to worry about too much. But if it's substantial long-term debt that they have on the books, like similar to when we talked about Domino's, the long-term debt, I've heard from, I think from Phil Town, that you want to be able to pay off long-term debt within 3 years of earnings. So if your long-term debt is more than 3 times your earnings, then that might be starting to be too much of a debt load. So what do you think about some of the debt on Lowe's?
So in a couple of slides we're gonna see about the debt. So I'm gonna show you. But from what you said, I mean, from what Phil Town said, having like 3 years of earnings to pay the debt, obviously it will not be the case for them, because if we add, for example, here, we can see that in the past 3 years they have made about 20 billion, and their debt is raised to 32 billion. But what I will say to Phil Town, even though he's obviously much more experienced and better investor to me, is that I would say it also depends on the structure, because let's say the long-term debt is have to be paid in 5 years is different than having to pay that debt in 30 years. So I really believe it depends on the structure. And as I said, later on we're going to be able to see the structure, how is it divided during the years.
Yeah, and I think that's fine. Like if you said they have 32 billion of long-term debt and their earnings were 20 billion, then they are able to pay it off in a year and a half. So that sounds like it would be fine.
No, I'm sorry. Maybe I expressed myself wrong. What I say is they made 20 billion in the addition of the 3 years, because it's 6 billion in 2023.
Oh, okay.
So during
it's
3
still,
years,
yeah, it's still in excess.
Yeah, it will be 12 billion short to.
So it's more like it takes them 5 years maybe to pay off their debt, long-term debt.
Yeah.
Okay.
I would say 5 years. But again, like I said, I will argument that it depends on the structure, and we're going to see this in like 2 slides. So right here, depreciation and capital expenditures, as we can see, when capex is about the same as depreciation, that means they are just investing money to keep in the same place. So just doing fixtures, remodeling some stores, closing some of them, opening new ones. But as we see, I mean, they are not growing in stores like, for example, a Costco. They are basically trying to get what they have, make it a more profitable, and with the extra money, as we saw before, they are just rebuying shares. The debt, as I said, they got into 10 billion, and what they've been using for that is just, as we see in the last line, is repurchasing common stock, which if we add up, they repurchased almost 30 billion in the last 3 years. That's huge, because their market capitalization at the moment is around 120 billion. So basically, they repurchase in value 25% of the company in 3 years. That's crazy. But as we said before, part of that is being with debt. And here's the debt structure that we've been talking about. So they owe 32 billion, but it's spread out in almost 30 years. So they be paying in more than 30 years, because you see the notes due fiscal 2062. Wow, that's almost 40 years. So again, I mean, I agree, say it's high, the debt, but I think the structure is pretty good, even though I think that the market rate of the interest is a little high for such a strong company. But maybe it is because what you said about being big, because
yeah, and maybe that's the best they could get in terms of the rates.
Yeah, absolutely. But again, we've been doing past companies, and I saw companies that I didn't think they were as solid as Lowe's with better rates. But I mean, again, the S&P and Moody's are the ones who, I guess, qualify them, and the banks, and whenever they do it, I mean, there's a lot of factors on it. But
yeah, well, it's interesting, but maybe we know that it's not likely that Lowe's and Home Depot will go bankrupt anytime soon. Like there will always be a need for home improvement, or all building improvement, and so their need is pretty recession proof, like you were mentioning earlier. So even though their debt obligations seem a little bit high, but you're not worried that Home Depot is going to go bankrupt in 5 years, whereas you're not worried that Lowe's is going to go bankrupt in 5 years, whereas that could happen to, say even other companies like trying to see one that I looked up recently, like a pizza chain, like a pizza restaurant. There's a lot of pizza competitors out there. So sometimes certain pizza chains go bankrupt every now and then. So they might be more of a concern than say a Lowe's. So I mean that I don't feel worried that Lowe's will be out of business in 5 years. I think you would probably agree with that, right?
Yeah, absolutely. I think it's such a strong company, but again, I thought the rate will be a little lower, but I mean, this is what I got. But I agree. I mean, they are a very solid company, and I think they are allocating their capital in the best way possible, which I think is buying your own shares if you think they are at a good price. And Buffett will sell it the same. So again, what would Buffett like? I think it has just one competitor, so not much competition. It has a huge return on capital invested. So as Buffett always talks on, because there's different ways to see returns on capital. What Buffett usually does is just add property, plant, and equipment plus working capital minus accounts payable, which if we saw, it was around like 20 to 23 billion, and they are making almost 6 to 7 billion, so a little around 30% in their return on invested capital, which is great. It allocates his resources to repurchasing shares, as we said before, which I think is a great use of capital. It serves the biggest market, which is real estate, again, hotels, restaurant, home, everything. So everybody in certain way needs Lowe's or Home Depot. And I feel it has a very high degree of predictability because of this. I mean, obviously it's not like they're going to sell 8 billion every month, but I mean, they might sell 25 billion in a month, and maybe next month they don't sell much. It goes up and down. But again, in 10 years, I mean, they're going to be selling around, I don't know, say if they are selling in the moment like 100 billion, I mean, they're going to sell around 1.2 trillion, let's say, like at least Lowe's. Home Depot is a little higher. And the questions I always like to ask, I mean, will Lowe's be able to take market share from Home Depot? As I said before, I mean, this is for you to get to a conclusion, but I just think they're very important questions. Is it possible to predict how is the housing market going to look in the coming years? Which is your favorite? Where does your close friends and relatives shop? I think one of the good things about this is you can really do a very qualitative analysis, because I think everybody that you talk to in the States goes to one or the other, and one of the other they're gonna have opinions on it. They're gonna tell you, oh no, I go to Home Depot because of the price, or I go to Lowe's because it's clean. I don't know. Everybody has their own judgment, and I mean that all adds up to get to a better conclusion, definitely. So this is what I had for you, Miss Shell.
Thank you, Alejandro, for all that. And for sure, like the great thing about Lowe's and Home Depot is that they're kind of a duopoly, just like how there's only Boeing and Airbus really that are the main providers of their services respectively. So if you think about that, like it could be something to look into both, like both Lowe's and Home Depot. And like that's definitely a point you raise that's important. Like, can Lowe's take some market share away from Home Depot? Like, what can they do to get bigger, unless Home Depot is just too dominant that it will always be number 1 and 2, just like how, say with burgers, I was looking up burger chains in Google Trends, and we can see like McDonald's is always above, say, Burger King, and that's always above Wendy's, and then all the others down below some of those. So is always going to be a number 1 and 2, or is there opportunity for the number 2 company to overtake some of these other companies someday? So that's definitely, I think, makes you wonder, what is Lowe's competitive advantage? And is it a big deal or not that Lowe's has 100 billion in revenues compared to Home Depot having 150 billion? Maybe that part is not as important as generating the final cash flow. So even if you do generate less in revenues, but what if Lowe's has better cash flows and better, metrics of what actually matter to really great investors like Bill Ackman? So he could be seeing that Lowe's is a superior business to Home Depot in certain metrics that he would rather invest in them compared to Home Depot. So those are all great questions to ask ourselves before we were to invest in any of these companies.
Yeah, I agree with you. And it also remind me of Coca-Cola against Pepsi and all this. And one different from, for example, because for example, airlines, just talking a little about a comparable, not a comparable business, but airlines have also few competitors in a certain way, but it's a very different business because again, in as we see, I mean, the return on invested capital for these two guys is great. In the other side, airlines having just few competitors, and obviously it's not that easy that to raise an airline in. It's not a good business. I mean, as we always heard from Buffett, it's probably one of the worst businesses is ever built. So yeah, I mean, I think it is a great company, a lot to learn from, and as you said, that is the big dichotomy of every one of these guys when they're second. But some of the things I believe it's important is like, even if they try to play offensive, do it in a profitable way, because again, just opening stores is not a way, which is, as we see, that's not what they're doing, because obviously you can grow sales and grow anything by just opening new stores, but that's not the purpose. The purpose is to do it profitably.
Yeah, right. And yeah, that makes me wonder what their growth strategy looks like, because I'm sure, the share buybacks can help with the providing more shareholder value, but I think that's Buffett's, say, favorite 3 out of the ways that you generate more profit. So from reading one of Buffett's recent shareholder letters, like either this year or last year, he mentioned how, while they've grown shareholder value by doing share buybacks, but his preference is really to grow the business internally. And then second would be to acquire other businesses that can add to the bottom line. So things like that, like, so it makes me wonder, like, if we are trying to invest, like how Warren Buffett does, we should evaluate what is their growth strategy and kind of like, does it make sense? And, what could be some other concerns with doing share buybacks sometimes? Like, for example, Buffett has been critical about the government's 1% tax on share repurchases now. And there's even talk that it could even go up to 4%. So that obviously might have adverse effects in corporate decision making, because maybe too many CEOs just easily, get debt and, put that into share buybacks, when maybe they should be using the debt to maybe grow the business in an organic way. I mean, there's so much, up for debate with what is the best way to allocate capital. But these are some of the questions that you have to ask yourself as to, when you look out 5 to 10 years of a company's growth strategy, what they're doing, and does it make sense the way they're trying to allocate capital to, both return shareholder value and also improve the society at large? Like, is it a net benefit to all of the homeowners or the professional construction workers that over the next 10 years, whatever Lowe's investing decisions are?
Yeah, absolutely. I agree with that, but I do like that the share buybacks by Lowe, just because different from Buffett, Marvin Ellison, I'm not sure how great of a capital allocator he is, But again, as you said, I mean, yeah, they can also grow by acquiring, I don't know, Ace Hardware, for example. But the problem with that, is that like most of the time when you read the acquisitions by companies, any field, anything, I hardly ever see something that you look, oh wow, that was a good buy. I mean, these little businesses always just raise that price so much, and management many times just to show that they did something and acquire something to grow sales, to grow work, I guess, to show that they did some work, they just pay whatever. And I just find those fusions are many times more hurtful than helpful. But I mean,
Oh
it's
yeah, right. And we see that play out in the stock market. Like if the market thinks it's not a great acquisition, you immediately see the buying company's share price go down usually. So yeah, it definitely is something to think about because a lot of times, say if there's a great business that someone else is acquiring, they're going to pay top dollar for it. So they're already paying for many years of future earnings, which may or may not be advantageous, like we saw with, like, say when Elon Musk bought Twitter, that may have been potentially a bad decision to have paid so much for Twitter when, it's kind of questionable how much earnings can you get out of that business.
yeah, I agree. I mean, Elon Musk is a genius in engineering, but I don't know how. I mean, if he's a genius valuing a business, so
Yeah,
that's what's important. I mean, having a great capital allocator at the top, which is not easy.
right. Yeah, for sure. I mean, who knows? Maybe Elon Musk will figure something out with Twitter or X to make it profitable and make it worth whatever he paid. But those are some of the questions. Like, anybody has to wonder, what is really worth it. So, yeah, I mean, this has been a fantastic conversation, and I'm so grateful we could learn a lot from you about Lowe's. And if anybody in the audience has questions, please feel free to share them in the comments. And we're happy to share investing knowledge. So thank you again, Alejandro.
Thanks to you, Michelle. It was a pleasure.
All right, till next time. Bye.